Warren Buffett is handing over the reins at Berkshire Hathaway, stepping down as CEO for successor Greg Abel. My next guest is a longtime Berkshire Hathaway shareholder who has a few key actions that Abel will need to take to maintain the firm's reputation. That's Bill Stone, the Glenview Trust Company Chief Investment Officer. He's with me now. Bill, it's great to see you. Obviously, nobody expects Greg Abel to be Warren Buffett, right? It's more just a question of how to push the company into the next phase. So let's kind of take it thing by thing, what you think that he needs to do. What's sort of job one here for Greg Abel?
I think you hit it the first maybe thing on the head, which is don't try and be Warren Buffett, following the greatest of all time, and certainly, throw Charlie Munger in the greatest duo of all time. Trying to beat them at their game, so to speak, is probably not the right thing. It's also a different company that it was when it started. It was a failing textile company, and they turned it into a massive, successful conglomerate. We now have a massive, successful conglomerate. So I think it leaves you with, I'm just going to essentially take right from what Warren Buffett has laid out, which is how he would really judge management if he was on the outside, which is watch for them to grow operating earnings over time. Secondly, decrease share count. And he's got a couple caveats on that. You want to do it when it's the right time to do it. Buy shares when it's below intrinsic value, so you're not diluting shareholder wealth. Also, if you buy those shares in, you're growing operating earnings per share at an even faster rate. And last but not least is look out for big opportunities. And that is really two things about that. One is Berkshire Hathaway is so big now that you have to find bigger opportunities to move the needle. Two is they have the balance sheet and $380 billion in cash. So they're one of the few, or, amongst the few that, especially when times are tough, can actually take advantage of those. And I think if you looked back at Buffett and Munger's track record, a few very good decisions was the majority of the great performance. Now, I will say they avoided making very many disastrous decisions, certainly made no large-scale disastrous decisions, so that's also an important part of it.
Well, and I guess that's my next question about Greg Abel is it a matter of more of avoiding mistakes and sort of steering the ship than it is sort of finding those big investments and big bets to make?
Yeah, I mean, I think you're probably right that it's tilted a little bit toward the, maybe I'd say toward managing it more, managing the conglomerate more, certainly more than Buffett and Munger did, which was frankly very little because they didn't enjoy doing that. And then secondly, you really can't force the opportunities. You have to, find them along the way. That certainly is a major part of it, to grow and to find opportunities. But you're probably right that some things have maybe moved more to the forefront.
And when it comes to managing too, do you think, I think we spoke to a guest yesterday who said Greg Abel actually, his management skills, to your point, the Buffett and Munger didn't maybe love that part as much, that his management skills might be better, or that he can bring some upside in that way.
I actually absolutely think so. That's probably part of my first statement, which is don't try and be Warren Buffett. Mm-hmm. You can actually bring a lot of value. And I think we've seen some of it already, frankly, before he's even taken the reins around, running some of the businesses a bit better. He's done, some nice, or been part of really turning around or improving the railroad, Burlington Northern Santa Fe, gotten the right people involved in the turnaround in Geico, which was extremely important to the overall firm. So I actually think it's paid a lot of dividends. And to your point, could Munger and Buffett have been very good managers? They may have. They just decided they didn't want to do it. They prefer to spend their time looking for opportunities and just let other people manage the businesses. There probably is, and I think we've seen it already, some real opportunity to add some professional management and skills in that part that I think Greg seems to bring to the table.
And Bill, as I mentioned at the beginning, you were a long-time sort of student of Buffett and Berkshire shareholder. And I wonder kind of how his sort of lessons have filtered down into your investing.
Yeah, I think so personally. So I was at Salomon Brothers when he took over and saved the firm. So it meant a lot to me. So I think one thing I always think of, my family didn't come from the business, but so I kind of got exposed to it through Gordon Gekko and Liar's Poker by Michael Lewis. And I would say, one of the thing is you don't have to be like, I'll say those villains or whatever. Shouldn't maybe say that about my coworkers at Salomon Brothers, but not all of them. But at least I think you can act a bit differently. I think the next part is just really quite amazing that he viewed it as I guess a duty to gather more wealth, but really just in the end to give it all away to society. And I think that's some really, I think, touching parts of it. When you go to the more investment side, I think he's been amazing in getting Benjamin Graham's ideas out there where you just say stocks aren't pieces of paper to us or to me. They are really looking at a company, and that's how I think about them. And, that was a big part of my change to thinking of it that way. And lastly is kind of the thing we all, as value investors, think about is the margin of safety. Can I buy this with enough margin of safety that if I made a mistake in my analysis, I don't have a catastrophe on my hands? That's a big part of it. And it really gets to my, or things he said, which I certainly believe, which is all investing is value investing. So while we in the industry kind of break things between value and growth, the fact is what you pay for something, whether it's a company that's growing earnings fast or not, matters.
And Bill, finally, I mentioned presumably you're a Berkshire Hathaway shareholder. Any plans to change your strategy vis-a-vis the shares, or you in it here and you're going to watch what Greg Abel does?
Yeah, so I'll say I'm a personal shareholder since 1999, and we at the firm own it on behalf of clients as well. There's no plans at this time. I mean, certainly, I'll just tell you, I gave you my lens of how I'll look at it. It's
right.
Exactly how Buffett laid it out. As long as I think they're going to continue to go down that path, to me, there's no reason to sell it, especially with the kind of downside risk that you have in it, which I think is very low relative, or catastrophe risk you have in it relative to most companies. So no, I think yes, you have to monitor it. Probably have to monitor it maybe a little closer than I used to when you had Warren Buffett. But I'm looking forward to learning what Greg Abel can do over time, and I'll be back in Omaha in May as usual.
Sounds good. We'll talk to you then, I'm sure. Bill, appreciate it.
Good to see you. So let's have a bull-bear debate here on Berkshire, Mel. And just full disclosure, you are a shareholder. We'll start with the bull case, though, because you say here, Mel, this is interesting. You say Berkshire has an all-weather quality, is how you put it. What do you mean by that, Mel? Explain that.
Well, thank you for having me on, Josh. I think if you look at the at Berkshire Hathaway, it's primarily an insurance business, but really it's large enough that it's a conglomerate. It's involved in many different places. So there's kind of a cyclicality and a counter-cyclicality within that portfolio. So you could almost even think of it as an alternative to a lower risk alternative to owning the broader market. And you're going to find some of the businesses like the insurance are counter-cyclical, but then other parts like the railroad are going to be more sensitive to the economy.
How would you characterize valuation here, Mel?
So in a year of pretty high valuations for U.S. large cap stocks, I think Berkshire's still pretty reasonably valued. If you look at the estimates for next year, it looks a little closer to the overall market on a price to earnings ratio. They prefer book value. I think that's fair because there's so many different businesses here. On book value, it's around about 1.5 times. That's historically a little bit higher than it had been before. Also, shareholders who pay attention know that Warren Buffett advocates repurchasing stock at 1.2. So it's a little bit above his level. But when you look at some of the other companies that make up the market, it's certainly reasonable, if a little bit higher than it has been in recent past.
And Mel, post Buffett, how does the bench look at Berkshire? Would you say that falls into the bullish column?
Cautiously bullish. We've had a couple of changes in that bench recently. That was a little surprising, I think, to investors. Todd Combs' departure in particular. Been there a couple of decades. You would have thought that this was the exact moment that he was waiting for, but there's been a change there, and that's fine. The bench is still deep. Greg and Ajay, these are very, very seasoned folk. It's reasonable to think that a lot of the the values that have brought the company to this point will continue to be in place. We wouldn't expect major changes. Wouldn't be holding out for a dividend, or I wouldn't be expecting major swings and aggressive allocations of capital. But there's definitely a culture in place that I think the bench will probably continue to keep in there.
So we walked through the bull case. Let's talk about the bear case, Mel. Let's outline that one. One concern you have, the risk of losing the Buffett premium. Explain that.
Yeah, there's no question. There's no investor out there. There's no CEO or investor spoken about as much, quoted as often. There's so many books out there. I mean, there's an iconic investor. We lost Charlie not that long ago, Charlie Munger. Warren Buffett is stepping down. And so, and anyone who's been to the annual event in Omaha will testify that it feels different. It's not a regular company meeting. So, is there some premium there? You could argue that some of that's been coming out over the course of the year. It's performed about 2/3 of the overall market performance this year. Some of that is related to some of the underlying business trends, which we can get into in a second. But there's definitely a caution out there that some of the core investors are investors in Buffett rather than in the actual fundamentals of the company itself.
You also say here, Mel, Berkshire's sheer size makes outsized returns extremely difficult. Fair enough. If that's true, Mel, what do you think returns are likely to look like then in the quarters, years ahead?
Well, I think instead of home runs, we're talking about singles and doubles, and I think we should be okay with that. This is a large cap company sitting on a pile of cash, and discipline is really important here. So whether it's the investment book or it's actually acquiring companies outright, they've always been happy to sit on cash, and that cash pile has grown. And so it's really hard to move the needle. And when you get to this size, like the very dynamics that got them to this point, it's going to be hard to replicate that in the future just because of the size. So I think that the discipline and the continued focus on discipline, again, what do they say? Waiting for that fat pitch. Well, waiting for half decent pitches is okay. But as long as that discipline remains in place, I think more reasonable or more market-like returns going forward, more broad market returns going forward seem reasonable.
You mentioned that cash hoard, Mel. What, as a shareholder, would you like to see them do with that?
Well, I think I think a dividend would be welcome because it would broaden the number of investors who can own it. It would also mean there's an awful lot of funds that would automatically, there'd be a lot of buying automatically into a lot of income funds where there's a rule there that you have to pay a dividend no matter how small. Apple discovered the benefit of that many, many years ago. So some kind of dividend makes sense. I wouldn't be holding our breath on that one. Ultimately, I think waiting for a better entry point to add to stock, repurchasing shares, that's also very valuable for shareholders. There's tremendous return for shareholders by being patient, disciplined, but then at the right time aggressive in repurchasing stock. So we're comfortable with that approach.
You've laid it out very well, Mel. I'm curious. So who is the investor, Mel, who should be putting new money to work in Berkshire, as you imagine it?
Yeah. So as you mentioned earlier, our clients are shareholders. I'm a shareholder personally. This is for the long-term investor, and particularly investors who find themselves kind of heavily weighted towards the high valuations, the market leadership, anything to do with technology or AI. You're getting a lot of diversification here in this name. Now, we like to think we can diversify for clients with different names, but there's a lot of diversification here. There's a little bit more of a value bent to this name than some of the other large companies in the market. So while near term, you may have some uncertainty here and there, long-term investors have been rewarded up to now, and even if it's a little bit more modest going forward compared to the past, we believe long-term investors will be rewarded for holding this name.
Mel, you broke it all down very clearly and simply. Thank you, sir.
Thank you.